Welcome to Intro to Loss Investigations. I sure wish we were meeting in person, but since we can't, I'm providing you with a little bit of audio background on this PowerPoint slide that I typically show the first day. So if you will click ahead to the next slide and just sort of follow along listening to my voice, that would be great. When insurance first began, it was in a coffee house in London called Lloyd's. It was named after the owner of the coffee house. Insurance didn't exist at that particular time, but it became the concept from which insurance developed. If you click on this link here to this YouTube video, it's going to give you a little bit more of an auditory on the history behind Lloyd's of London. And it's very, very interesting. So from there, mutual insurance companies became really the first type of insurance company out there. And a mutual insurance company is where the policy holders actually are owners in the company. So all of the people that wanted their property insured would pay money into this pool sort of, and then if there was a loss, that money was pulled out of that bucket to pay the losses of those that incurred them. And that's the first type of insurance company that was established. From there, insurance companies then started to become stock companies. And obviously in a stock company, people buy that stock to make money. So the first stock insurance company was in America was the Insurance Company of North America, affectionately referred to as INA, and that was back in 1792. INA merged with Connecticut General to become Cigna Insurance after a while, and then later on, many, many years later, not too many years from today, that business was sold, and I believe it was purchased by a company called Ace Holdings. So INA no longer exists today. But with a stock company, the policyholders don't own the company. They're not owners in the company, but the stock company is owned by stockholders that issue the insurance policies to the policyholders. This is a FIAMAC that was issued by INA at the time. In the 1750s, insurance companies didn't necessarily give you an insurance policy, but they would give you a FIAMAC. And the MAC would go like this metal piece would go on the buildings of a home or a business so that everybody in the community knew that your home was insured. It was also a way for the insurance company to determine if there was a loss, which insurance company was providing the coverage at the time. Back then, insurance policies were issued only for the peril of fire and issued to the structure only. Up until the 1830s, insurance companies could not do business out of the state where they were domiciled, out of the state that they called home. So if you were an insurance company in New York, you could only write insurance or provide insurance coverage for property in New York. And the same went with all the other states. But what the insurance industry found was they had a problem due to the lack of geographic diversification. Insurance is built on a concept called the law of large numbers. Insurance companies want to sell insurance to people that have similar loss exposures. It's called similar homogeneous exposure units in insurance language. But that means that if they can insure 100 homes, for example, then they're edging their bet by figuring not all 100 homes are going to have a fire at the same time. So they can collect the premiums of the many to pay the losses of the few. But as you can see here, by just two losses that I indicated, the 1835 fire in New York and the 1871 Great Chicago Fire, that because they only insured, an insurance company only insured in a certain area, they therefore were not able to spread the loss or the risk correctly. So if the city of Chicago burns and you have, as an insurance company, you have a whole bunch of property insured in the city of Chicago, you've just had to pay out a whole lot of money. So you can see here that when that fire hit in Chicago in 1871, 50% of the property owners had insurance. Out of the 50%, only 40% were able to recover because that's all the money the insurance company had set aside. So out of the 200 insurance companies in Chicago at the time that insured property, 68 of them went bankrupt as a result of the Great Chicago Fire. And at that time, if the insurance company went bankrupt, the property owner was not going to get any of their money. So here you've been paying money for insurance all that time, you have a loss, and it's not covered. So today what the insurance company looks at is they allow the geographic diversification. So State Farm, for example, is housed in Illinois, but they can sell insurance and they sell it in all the states, I believe. They certainly sell it in Wisconsin. And also splitting of risks, meaning if an insurance company has too many policyholders in one area, or they're insuring a property that is too large and puts too great of a risk on them, the insurance company themselves can buy an insurance policy to back them up if the loss is too great. And that's reinsurance. That's called reinsurance. So here you can see the difference in the amount of losses that were paid once geographic diversification was allowed. So here for Baltimore, $55 million in claims as a result of their fire, and 90% of them were paid. Makes a huge difference. It keeps the insurance companies financially stable. Risk is defined as the uncertainty concerning the chance of loss. When you get behind the wheel of your vehicle and you head out for a ride, you don't know if you're going to get involved in a car accident, if you're going to slip on the road and lose control of your vehicle, hit an object, somebody gets injured, or if somebody behind you is going to lose control of their vehicle, run a stop sign, not pay attention and hit your car. So that's the uncertainty that we face in our day-to-day lives, is that we don't know if we're going to have a loss. Hazard risk is a type of pure risk, and that's the risk that we face, the one that can only produce a loss. If you don't get in a car accident, for example, you haven't won anything, you don't profit from that. But if you do, you lose, and that's a pure risk. A business risk is considered a speculative risk. You might make money, you might lose money. So when the insurance company decides whether or not they're going to insure you and your automobile, they don't know if you're going to go the entire 6 months or a year without having a loss and they make money in the premium that you've paid, or if 3 days in you're going to have a total loss and they lose money. They end up paying out more than they took in premium dollars. And so that's the risks that the insurance company faces. There are 4 ways to manage the risks that we face or that a business faces. They're all the 4 steps, all the same 4 steps. Avoid, reduce, retain, or transfer. The only way you can completely avoid a risk is not to have it. If I want to avoid the chances of me getting involved in a car accident, the only way I can do that is to not have a vehicle and to not drive. So you have to completely eliminate the exposure in order to avoid it. There's many things that we can do to reduce our chances of having a loss. We always want to make sure in the winter that our windshield is completely scraped off so that we can see, we get the full vision, and that our tires are good, that our brakes are good. Maintaining our vehicle is another way that we can reduce the chances of us getting involved in a loss. We cannot use our cell phone when we're driving. That'll reduce our chances. There's not much you can do about screaming babies in the back seat. I used to think about that when my kids were younger. Very distracting. And retaining the exposure. We often retain exposures in part by taking a deductible on our automobile insurance. So I carry a $1,000 deductible on my collision. Therefore, I'm retaining the first $1,000 of my loss. When my boys were driving and on my insurance when they were in high school, I retained the physical damage to their vehicles in whole, meaning I did not insure it. I just insured it for liability. So if something happened to the physical part of the vehicle, we were going to have to pay that out of pocket. You can transfer the risk one of two ways. The one that we're most familiar with is via an insurance policy. So you buy an insurance policy and you pay a known premium, and in return, the insurance company says, hey, if you have a loss, we've got you covered. That's one way to transfer risk. Another way to transfer risk is via a contract, a written agreement. Businesses often use these, but there are times in our lives where we see it as well from an individual standpoint. If you rent a vehicle, for example, they'll have you sign the release saying if something happens to the car that you're going to be responsible for that. That's a way of the rental car company transferring their exposure of loss to you. And so regardless if you decide to retain or transfer the exposure, you always want to reduce. You always want to look at ways of minimizing your exposure to loss. I park my vehicle in my garage every night and shut the garage door, so that reduces my chances of somebody stealing my car. These are just some terms that you'll become familiar with. We just talked about insurance being a transfer of risk. An insurance policy has two parties: the insured, who is buying the insurance, and the insurance company, who is providing a promise of coverage. In order to insure something, you have to have an insurable interest in it. An insurable interest can be defined as love or money. So I have a financial interest in my home. The bank also has a financial interest in my home. So I can insure my house and I list them as the mortgage company. If I don't have an insurance policy, they have a right to insure my property for their interest. The love interest really applies in life insurance. You can take out an insurance policy on someone that you have a very close relationship with, a family relationship, for example. Grandparents can buy insurance policies on their grandchildren because they love them and they want to be able to provide this financial vehicle for them as it can grow over time. We talked about the Laura Lodge numbers and how that works, and that the insurance company is always looking to insure similar exposures in a very large number so that they can, what they say is, insure the many, obtain the premiums of the many to pay the losses of the few. I'll let you read the cost-benefit analysis here of an insurance policy, but the insurance industry is very stable. People need to have insurance. If it wasn't for insurance, you couldn't buy a house. A bank's not going to loan you $200,000 or $300,000 and you don't insure it, and they take the chances that the house is going to burn down and you are not going to be able to financially repay that mortgage. At the same time, you wouldn't want to take on the risk of buying a home if you couldn't insure it, because what happens if it burns down and you no longer have the house and you still have the mortgage and you don't have a way to recoup that money that you lost? So the insurance industry is very, very stable. We very rarely see a lot of huge layoffs going on in the insurance industry. In fact, right now, there's a staffing shortage because a lot of the people in the industry are in my age bracket or older and are retiring soon. So the industry is always looking for that new funnel of people coming in that they can train and that can take on some of the intelligence of those of the people in the industry that are leaving. Two final terms on this slide: indemnity. Insurance contracts are contracts of indemnity. They are designed to restore the insured back to the same financial condition they enjoyed before the loss occurred. Not make them better, not make them worse, but to make them whole. So one of the examples that I always use is many of you may have had a grandmother that had the big console TV, and you would lay on the floor and watch the cartoons in her living room or watch your shows in her living room. Those don't exist anymore, obviously, but grandma might still have one. If grandma had a fire in her house, the insurance company is not going to be able to find her another console television. Goodwill doesn't even have them. So what they could do on an actual cash value basis to send her back to that same financial condition and not make her better would be to give her $25 for the loss of that television, for example. Replacement cost makes you better. So replacement cost actually goes against the concept of indemnity, but it's mostly how homeowner policies and renter policies are written. In reality, for grandma, if she lost that television, the insurance company would buy her a big flat screen TV. That makes her better. Grandma's going to like that, but that goes against the concept of indemnity. When we make somebody better as a result of a loss, we encourage people to have losses. The last term is consent to settle. This applies in liability insurance policies, and oftentimes insureds are very upset about this. This is a clause built into the insurance policy that says if you have a loss and you cause damage or injury to another party, the third party, remember insurance contracts a party of two, but if you injure or damage somebody's property, they become the third party. The insurance company does not need the insured's permission to settle. I get involved in a car accident and I rear end somebody and I say to the insurance company, no, don't pay them. I don't want them to get any money. I can't do that. The insurance company has the right to determine whether or not they are going to pay that loss. When I was handling claims, I would often have people call me very upset. Why did you pay this loss? It wasn't my fault. It's the insurance company's right to determine if you were at negligence and how much they are going to pay. So I hope you enjoyed this general overview of insurance concepts before we actually get into the textbook. As always, if you have questions on anything, feel free to reach out to me.